Welcome to the Silent Trading channel. Today I'll be analyzing the gold chart on Thursday, 8th of January. But before you guys watch, please subscribe, like, comment, and share the video below. I'll be starting on a 4-hour time frame today, or the 4-hour candle, to check if the price right now is in a buy side or sell side price action, because we need to be able to confirm whether the price action is to the sell side or the buy side before we entering a trade, or at least before we start to place a buy limit. As you can see at a 4-hour time frame, I've been emphasizing in my previous video yesterday that price have more chances of moving down further and further. Because why? Because I've said that the price is going to be in a consolidation phase because of the triangle that I've drawn. Because why do I know that this triangle is going to be the consolidation zone, or the consolidation box that the price will be consolidating? Because most of the time price will push up, but price will never push up to touch resistance or push down to touch support, because by touching resistance and by touching support, the market is going to be triggering buy limits or sell limits, placing at resistance, or buy limits placing at support. Which means if the price is going to be consolidating, the price is going to go up but not touching key support, not touching key resistance or key support. Because by touching key resistance over here, price is going to be triggering sell limits, and by triggering sell limits, which most of the retail traders are placing sell limits over here, price will have to push up further. So price will only push up as far as it could, but never touching key support and resistance. Price will also push down as far as it could, but never touching key support, because by touching key support, the price is going to be triggering buy limits at key support over here. And by pushing up to touching key resistance, the market is going to be triggering sell limits. Or by triggering sell limits, which means retail traders are going to have their position triggered over here. So when most of the traders get their sell position over here, or their short position over here triggered, which means the price on the market would have to be pushing up further. Because why? Because most of the time, most of the traders, or majority of the traders, is going to suffer losses than profiting. So when market push up, triggering sell limits, which means majority of the traders are getting sell position or short position, which means the market needs to push up further. Correct? Because why? Market manipulators is not gonna be allowing most traders to profit, because if most traders are profiting, who will be the one paying them? Correct? Institution will be the one paying them. Banks will be the one paying them. So will banks and market manipulators allow this? No. So by doing this, I know that most of the time when market push up, but never pushing up enough to touch resistance. So by not touching resistance, the market is not triggering sell limits. By pushing down and not touching key support, the market is not triggering buy limits. So this movement down over here, which is what I've been analyzing from yesterday, that price is more likely to go down, creating a more lower low, because this is what I call a sideways down, or consolidating down. And by consolidating down, the price is more likely to accumulate buy volumes over here. Buy volumes at where? Price is slowly accumulating buy volumes by pushing down, touching support once and once again, and it's now tricking those buyers into buying more and more. Why? Because every time price push down, touching support, triggering buy limits, there are buy limits over here which are small buy limits, but there are still people entering buy position at this small support over here, this insignificant support over here. This is what most retail traders are doing, because retail traders are always buying and selling at every support and resistance rather than waiting at key support and key support level, key support and key resistance, because retail traders don't have the patience or the discipline to trade. So when they don't have the patience or discipline to trade, they will always be entering an order, they will always be opening a trade, they will always be entering a position, no matter where or when the price is moving. So if the price is moving a little bit down, retail trader will start buying. Why? They buy wishing the price will go back up, they buy wishing the price will reverse, and most of the time price will reverse for them to collect small wins, collect small pips win. But at the end of the day, what the market is doing is tricking them into believing that the market is going to reverse, and when the market push down further, they're going to start buying more, and the market push down further, they're going to start buying more and more. So when the market has pushed down enough, when the market has toyed enough with their psychology, the market is going to start breaking out below as soon as possible. Because why? When people start to buy and buy and buy, because believing that the market is going to reverse, because the market is always pulling back up. You see the candle pullback, you see the candle pullback, you see the candle leaving a wick here. This pullback makes those traders think that the market is going to reverse around here. They think that the market is going to reverse every then and there, and they keep buying and buying and buying and collecting small pips win. But at the end of the day, the market sidewaying down here over here is accumulating buy volume from all this support over here, right? So when all this support is triggered, the next thing the market will have to do is to push down. The market will start by sidewaying down like this, right? Sideway down, sideway down. And when the market has accumulated enough buy volumes or enough buy position from buyers, and by tricking enough buyers into buying, and when more and more buyers are buying, correct? This is what I call accumulation. Real accumulation occurs at support and resistance. This is what I call accumulation. Accumulation of what? Accumulation of retail traders' position. Accumulation of the volume retail traders are bringing into the market. So by tricking them into believing that all this support is going to hold, these buyers are going to keep buying and buying when the market push down and touch support. All those buyers are going to keep buying and buying. So when those buyers have buy enough, the price is going to start dumping down, right? And a sharp dump and a sharp push downward will cause all these buyers to be panicking. All these buyers will start to panic, and by panic, and in a panic-stricken state they're in, will really cause them to go into I'll call a frenzy or a fear-stricken state. They will either, if they are trading in the Forex market, they will start to be hedging by entering a sell position or a short position for their buy position to go into a lock state, for their buy position to stop going to more losses. They'll start hedging using sell limits. They'll start hedging using sell position for their buy position to stop going to more drawdown, or at least some will start cutting off losses, closing off all their position. And when the market get a sharp push downward and people start closing their position, only then the market will start to reverse like this, and then push down and start to reverse up. And when the market has cleared off enough buyers and the market start to reverse, when the market starts to reverse, the next thing the market is gonna do is gonna be what? It's gonna start accumulating sellers into the market. Because why? When the price has pushed down far enough, sellers are gonna start believing that the market is going down. When sellers are gonna start believing that the market is going down, sellers are gonna start selling at all resistance created in the chart. So by market pushing up, sellers are triggered over here. Sell position are triggered over here. Sell limits over here. Sell limits over here. Over here. Over here. Over here. And over here. So do you understand that what I'm trying to say that is, for those who are experienced in trading, we wouldn't be entering at all support and resistance every time. We will be choosing which support or resistance that we will be using to enter a position that has a win rate, that has a high win rate, not a low one. But we will not be entering all the plays that others are entering over the chart. Every support gets some buyers into the market. Every support gets some buyers into the market. But we do know that all those buyers are all retail traders, correct? But people who are experienced are not buying at all this insignificant support, insignificant resistance. We are not buying, we are not selling at insignificant support or resistance. We are only waiting when the price push down and pushing down, but not going down deep enough to trigger buy limits. Because by triggering buy limits, the price will have to push down further. So when the price push deep down enough, but not triggering buy limits at key support, is where I'll enter my position. This is how I trade. And when the price push up and push up high enough, but not high enough to touch and trigger sell limits at key resistance, this is where I'll be entering my trade, because I'll be entering my trade at what? My criteria or my condition to entering a trade is to wait for the price to push up above resistance, beyond weak, creating a new high, but not touching the next resistance or not touching the key resistance. This is where I'll be entering my position, is the week before the key resistance. Why is it so? Because price are likely to reverse before touching resistance, or price will go beyond resistance and will reverse above resistance over here. So there are only two possibilities of the price reversing. Is price will reverse before touching this resistance over here, which is what I call a key resistance, or price will either push up, triggering sell limits and pushing up further, clearing off all sell volumes before reversing. So price is only likely to reverse before touching key resistance, or price will reverse before touching key resistance, right? Or it will reverse after key resistance. That is all the price is going to do. Because if price is going to push up, over here, pushing up over here means only clearing off all sell limits volume from over here, right? And pushing up to create a new high, but not touching the key resistance, not triggering sell limits, and then start to reverse over here. Or the price can do another thing, is retrace and then push up, touching key resistance over here, triggering sell limits, accumulating sell volumes, and then push up after accumulating sell volumes. And then a high push up to what? To clear off all sell volumes from the market. And after clearing off sell volumes, where the price start to reverse and retrace and then push down. This is the only thing the market is going to do. If it is reversing, it is not reversing at key support and resistance. It is only reversing before key resistance or after key resistance. That's all the price is doing. Correct? So right now the price still has a more chance of moving down. So we'll be waiting to buy at this zone below here, which what you guys will be calling a fair value gap. But I don't call this a fair value gap. I'll call a zone below, a zone before key support. That is what I'm calling. I don't call this a fair value gap, because I trade based on price action. I trade based on psychology. I don't trade based on pattern name. I don't trade based on zone. I trade based on action. All right. So this is what I'm doing.